Here's your closing bell. All right, there's your closing bell on this hump day. Let's check out the numbers. We did finish in the green again. Nice bounce back day for the Dow. 526-point gain, 1.6%. The S&P also on a roll, gaining about 1.5%. And check out the NASDAQ. Perhaps Santa Claus is indeed coming to town. 1.5%, 162-point gain. For a closer look at the broader markets, let's bring in Jim Caron, Chief Fixed Income Strategist at Morgan Stanley Investment Management, and Dan Pipitone, co-founder and CEO of TradeZero. Nice to see you both. And Jim, we'll start with you. What do you make of today's rally?
Look, I think it's a nice reprieve from what we've been seeing. And, I go back to some of the risks that did come into the marketplace, which was, obviously the Fed, potentially for the Fed to move interest rates up to 5 to 5.25%. And I think what the markets are starting to realize is that, we may be able to get through some of this. It's certainly going to be bumpy, but I don't think that it's a risk-off environment. At least it doesn't seem like Fed policy, even though it's supposed to move up towards 5%, is going to be an extraordinary tightening of financial conditions. And I think a lot of people are pricing in bad outcomes for the first half of the year. And to the extent that we outperform those outcomes, that could be a positive, and that could be, potentially what's behind some of the technicals and seasonals that go into the end of the year.
Dan, what do you think? What do you think today's gains, I guess, are signaling just in terms of what we could see in the coming weeks?
I think, Santa Claus rally, not sure. Is this a reaction to what we've seen over the last month and a half? Have things really been beaten down? Or is it, really a sign alluding to what Nike reported today in their earnings numbers and what they're guiding to as to maybe this being a much better holiday season than we anticipated coming into it? And the Dow rally today, I think, is reflective of that. Moving into the first quarter, we are seeing some headwinds continuing, especially in the retail trading space, where we do believe interest rates will peak out 5.5%, sort of the middle of next year, with some relief thereafter.
Yeah, Jim, a nice bounce for Nike and for FedEx coming off their earnings reports yesterday. How indicative are those two generally pretty decent bellwethers of the economy in terms of what's coming next?
Well, look, I think the consumer is still in reasonable position these days. Wages are still reasonably high. They're coming down, but they're certainly not collapsing. The labor market's very strong, even still. So people are making money. Incomes are there. Wage inflation is still running somewhere around 5%. There's shortages in the service sector of the economy. So I think in that sense, the demand to spend, whether it's Nike or other consumer related assets, I think I think it's there. I think it's absolutely present. And we can't really underestimate the consumer right now. And don't get me wrong. It is weakening. Things are slowing down by design, but it's not collapsing. And I think what's been put into the prices, or at least the sentiment going into the next couple of months, is probably something more negative than what the markets may actually deliver, or the economy may actually deliver, really.
Dan, you have a strong look, or a good look, I should say, at the retail investor right now. What are you seeing just in terms of activity, given some of the uncertainty that we're up against?
2022 is not 2021, clearly. The second half of this year has definitely been challenging with respect to retail trading volumes. And while we are still seeing retail actively engaged in the markets, I think they're just doing a lot less than they have in the past. And so Santa Claus rally or not, we are looking at some headwinds coming into the first quarter, and really retail navigating stories that they haven't really been privy to the last couple of years. Recession talk, rising interest rate environment, choppy markets, things not moving only in one direction. So once we ride out the first quarter on into the second, we do believe that volumes will start to pick up again.
Jim, you write of a, quote, real fat-tailed risk lurking in 2023. What is that?
So I think there are two of them. I think to one degree that we could be in a situation where inflation picks back up, and we're not going to know that until the end of next year, or at least towards the third or fourth quarter of next year. And if that happens, then the Fed may have to restart their hiking cycle. So that's a tail risk. I mean, that's certainly a risk event. But the other risk event that's out there too, which I also consider a risk, is if things don't slow down enough and that asset prices rally beyond what people actually think. Many people are not priced for that either. And I think they're going to be forced to chase returns. So the two fat tails really suggest that there's a decent probability that you could go in either direction. So what that tells you is that as we sit here right now, we can expect higher volatility going into 2023, just because it's so uncertain as to which way we can actually go. And I think that the events, particularly if inflation doesn't become anchored, goes down but doesn't stay down, and that brings the Fed back in, I think that could be a very negative outcome. And that's certainly a risk case, not a base case. But the other risk case out there is that we just don't get the slowdown, that everybody's anticipating, and that asset prices stay relatively high and people miss it. And then they're forced to chase at really bad levels, and that creates a bad technical for the market and makes us due for a correction if that's to occur. But again, that's probably sometime in the first half.
Dan, it's always extremely tough to time the market. We hear time and time again, you shouldn't try to time the market. But for those retail investors that are looking to get in right now, where are you seeing, I guess, what is your advice just in terms of where they should put money to work?
Sure. Well, what we're seeing actually is sort of a pivot in the retail trader where, there were essentially two strategies that folks would follow for the last couple of years, picking those stocks that they were really enamored with on the long side, and then actively day trading some of these, small and mid cap intraday gappers, which those two things still exist. But what we're seeing now is that folks are building portfolios, a lot of times anchored in these beaten down tech names, and then trading around those portfolios. So from our perspective, we really focus on the active retail trading segment. We are seeing now folks kind of rein the activity in a little bit while building portfolios and leveraging their investments more while they're trading around those portfolios.
All right, Dan Pipitone, Jim, Caron, always great to have you. Thanks so much for joining the program here.